It is no secret that real estate has made more millionaires in the history of our nation than any other asset class. So watch this quick video to learn a simple strategy that anyone can use to build legacy wealth long term. All right, friends, so this strategy begins by buying a starter home to live into. All right, live there for a few years. While you're there, hopefully the home has gone up in value, which means it's appreciated. And at the same time, try to save money from your income for a down payment on another house. So then in a few years, you buy a second house to move into. So rather than buying an investment property, which requires 20 to 25% of the purchase price as a down payment, buying another primary home to move into only requires a 5% down payment. That is a huge difference in money. So think about it. If you're buying a $400,000 house, if you were going to do the investment property, you're showing up with $100,000. Most people don't have that kind of money. But if you're buying another home to live in, you're showing up with $20,000. So over those few years that you lived in that first house, if the market's gone up in value, well, then you could do a cash out refinance and get that needed down payment from the first house, and then you can have that to buy the second house. All right, well, how do you make it so you don't have to cover 2 mortgage payments? Well, we're gonna keep the first house and rent it. So we get a little rent study done, and if the appraiser does his evaluations and decides that the home could rent, for example, for $2,000 a month, well, then you get credit for 75% of that. So $1,500 to offset your mortgage payment on that first house. So if your mortgage payment is less than $1,500 a month, it's a wash. It completely disappears from your pre-qualification for the next house. If it's a little bit more than that, all right, well, so then you're just carrying a small debt to also qualify for the new house. So you're gonna rent that home. It's gonna provide you cash flow, appreciation. Now you got 2 homes going up in value over time. All right, a few years later, you can rinse and repeat. And the rent that can be produced by the, I guess you can call them the departing homes or the trailing homes, can be used to offset the mortgages. So if you've got skills to fix things up, like to buy a fixer-upper, this strategy works even better. So you can buy houses even cheaper. You can put in your own sweat equity, and then even if the market doesn't necessarily go up in value, you can, it's called forced appreciation. The house will be worth more because of the improvements that you do to it. Now, just one more thing, imagine with me 10 years down the road of pursuing this strategy. You might not even have to save the down payment for the next house from your earned income. I mean, that first house that you bought after 10 years, it might be double in value. So you can go back to previous homes and potentially do cash out refinances in order to get the money you need. All right, my name is Ryan Yankee. I would love to help you, teach you, and be there for your friends, family, and coworkers for any home financing needs. My number is 719-210-5517.